Hello, my name's David Stuart. I'm the Chief Investment Officer of Tasplan, and I'm here to provide you with a June investment update. Now, at the time of our last update, which was in April, things were looking pretty gloomy, it must be said. We're at the commencement really of the COVID outbreak across the developed world, and we'd seen increasing levels of lockdowns being implemented across most of the world's major developed economies. We were on the brink of an economic recession given the implications of those lockdowns, and we therefore had very strong government spending or fiscal stimulus, and we also had interest rates that had been cut to virtually zero around the world. Equities had fallen very significantly during March, and although they had started to bounce somewhat from those lows, the outlook still remained very, very uncertain. So things didn't look great. As little as 2 months on, everything starts to look a little bit rosier. The COVID environment seems to have peaked in most of the world's major developed economies, so it's gradually been in retreat, and we're gradually seeing the lockdowns being eased, which of course will help economic growth going forward. We haven't yet seen a major second wave incidence of the COVID virus, which is clearly one of the health risks around, and people are taking that quite positively. We've actually got an economic situation at the moment which is quite depressed because of the lockdown, but the forward leading indicators are all beginning to turn positive because people can see through that as the lockdowns eased, things will start to improve, people will get their jobs back, and people will start to spend money. So given this very strong fiscal and monetary backdrop, and given that the leading indicators are improving, we've actually seen continued rally in equities. So equities have been rallying now for close to 3 months, and in many cases are not significantly below the levels they were at the beginning of the year before the virus actually started. So from this point, it looks like we may be witnessing the world's shortest but sharpest ever recession, and also one of the shortest ever bear markets. Currently we only had 3 weeks of an equity bear market. But this may sound too good to be true, and I'm going to point out some of the worries which still exist and which could cause further instability in the economic environment and therefore equity markets. In terms of the economy, although we will see an uptick given the severity of the downturn, we think it could still be quite a weak recovery, and in fact it may be years before the output of major economies returns to the level it was just last year in 2019. Unemployment is likely to remain high. It only generally comes down relatively slowly, and we're also likely to see business investment quite muted, given that many businesses will still be operating with surplus capacity. That means profits may also remain somewhat depressed from their levels prior to the coronavirus. Now, interest rates are likely to remain very low for precisely the same reasons. I think that we're likely to see maybe 2 or 3 years of very low interest rates in the US, in Europe, and even here in Australia. So that's quite positive because that does help to support financial assets. So those interest rates will continue to support equities. They'll also support other assets such as property and infrastructure. And they are one of the reasons I think we've seen such a sharp rebound in equity markets. However, I think there are still future risks ahead of us that we need to be careful of. The first one is clearly that a major second wave of COVID is possible in any of the world's major economies, although I believe markets don't believe it will be accompanied by the same level of economic lockdown as we've just seen. So there may be a health crisis, but it may not result in to the same extent in a further economic downturn. Government spending is currently very, very high, and we know that that will need to be reined in. Here in Australia, the government's spending a lot of money on JobKeeper and JobSeeker and other programs to offset the economic downturn. And we know that those measures are likely to expire around September in general, and that will take away, if you like, some of the pulse which the economy's been receiving from the government assistance. We do think that some industries are likely to maintain or to continue to have problems with their trading for some time into the future. And these are fairly obvious ones, such as airlines and airports, also the tourism and hospitality industries. So they may be quite far-reaching in terms of how long they have to operate in quite a weak demand environment for them. And as a result of that, we're likely to continue to see further bankruptcies possible both in Australia and around the world in these areas which have been badly impacted as time moves on. Another issue is that in the US, they now have not just a health and economic crisis, they also have a bit of a social crisis with the Black Lives Matter movement and the protests which are accompanying it. We think that they may well continue through to the presidential election in November, and the election itself may also be a time when equity markets start to be somewhat concerned. If there is a move to a Democratic presidency, it would be fair to say that from a business perspective, the Democrats are unlikely to be as friendly towards them as Donald Trump has during his time as president. So equity markets may well take the election of Joe Biden as something of a negative for the financial markets. Now, in terms of equity markets, we must admit that having seen this rebound, valuations are back to relatively high levels by historical standards. Now, they are very difficult to calculate given that at the moment there's so much uncertainty as to the level of profits and earnings that companies will manage to earn. But it does look like valuations are probably historically incredibly high, admittedly supported by this very low interest rate environment, but that remains a concern. When valuations are high, there is always potential downside. Now, it's also fair to say that we're seeing some signs of froth in markets around the world, particularly in the United States. We've got companies which have absolutely zero sales at the moment with $20 billion valuations because people think that they're in a great field. And we've also seen companies in bankruptcy, like Hertz, actually looking like they're able to issue $1 billion of equities into the market to refinance themselves. Again, a pretty unprecedented idea for a bankrupt company to have a share sale. Now, it's always very hard to time sentiment, so although we might acknowledge that sentiment seems quite bullish and optimistic, it's difficult to know how long that could go on for. But typically when we think that sentiment may have pushed markets a little far in the short term, we would make sure that we maintain diversification and try and limit risk across the Tasplan portfolios. So that's really the situation we remain in at the moment. Now, I should apologise for being somewhat downbeat when the market backdrop looks so positive. It is fair to say that the returns that members will earn this year have clearly improved a lot over the last few months, and the returns for the financial year now look like they'll be quite reasonable. However, I do think it's important not to become complacent because markets have been going up, and to be aware that there are still potential risks out there, and there are still some possibilities that equities could have a further downturn in the future. So I'd like to thank you for your time, and I hope that next time I speak to you I might have a more cheerful message than maybe the one I've given you now. Thank you very much.